Good afternoon. I'm Mike Toglia, the publisher of ABL Advisor, and welcome to our latest edition of the ABL Advisor video series. I'm here today with Andre Hakkak, Chief Executive Officer of White Oak Global Advisors. Thanks for being here today, Andre.
My pleasure. Thanks for having me.
Pleasure's all ours. I'd like to start in on the topic of today's discussion, which is your insights into the institutional investor market and why they are investing in the private credit opportunities today. With that being said, I'll start right in on the first question, and that is, there's been some change in the market. So why are institutional investors looking more closely at private credit opportunities today? Is this a function of the search for yield in a current low interest environment, or is it for diversification of portfolio?
It's both. Investors have been searching for yield for quite some time now, and it's hard to find it in today's marketplace. You have junk bonds trading below 4% in yield. So if you go into the higher credit quality, if you're talking about treasuries or short duration treasuries or things that are longer duration, high quality investment grade, it's very difficult to get 2, 3, 4% today. So I think a lot of institutional investors are trying to search for yield in the marketplace anywhere they can get it. And you can find higher quality investment grade paper that is private in nature. You can say it's bankable, and get maybe 100 to 250 basis points of additional yield than what the equivalent of the publicly traded world is providing investors. So that's one reason. And of course, portfolio diversification is the second reason. You can find private credit all the way in the opportunistic world, getting investors anywhere between 8 to 12%. And you can also go to near investment grade, 5 to 8%, and of course under 5% you can get also investment grade paper. So that diversification helps quite a bit. And when you look at the long-term returns for hedge funds or even private equity, their returns have not been as great as one would have expected. So therefore, when you can get senior paper or even in some cases mezzanine paper, getting yields anywhere between 6 to 12%, that return profile is attractive for institutional clients' portfolios, whether you're a pension fund, a DB plan, or other types of institutional investors in the world.
So thank you. You answered the next question I had, which was the expectation of the returns that these institutional investors were looking for investment grade and non-investment grade, and you've really addressed that already. But has this changed a lot over the past, let's say, 2 years? Have you seen an influx of interest from the institutional investor market, and they're really coming into play at this point? When did this all start?
Look, I think if you go to the history of private credit, it goes back 30 plus years. It really started with what used to be called the mezzanine fund or mezzanine product, which arguably it wasn't actually mezzanine. It was a senior secured paper providing leverage to private equity funds. So that was a 10, 12% product with 1% warrants. And so that product was really the key catalyst for providing leverage to PE firms. So when the prior to the financial collapse of 2007, 8, 9, a lot of mezzanine funds didn't do so well because the private equity backers either did not support their portfolio companies or they weathered away. And a lot of those managers reappeared in 2010. And they rebranded themselves as senior secured direct lending managers. And it's sponsored back, so it's safe, and it's top of the capital structure. Well, that's essentially what the mezzanine funds were before, but you got paid more for the paper. But now you have an advent of managers coming to the market in 2010. I think we went from 30 managers to close to 300 managers. Now there's 500 managers. So 300 managers came out and said, direct lending is providing, debt to PE firms. And so that's really one evolution that's occurred. And even to this date, when I speak with investors, since White Oak does limited number of sponsored deals, people will say, White Oak, we love what you do, and we really like to characterize it as specialty lending. And of course, my natural reaction is, well, what is core lending? What is non-traditional lending? What is traditional lending? And they said, it's sponsored lending. I'm like, well, there's 15,000 sponsored companies in the world. There's 400,000 that's not sponsored. And you have 400 or 500 managers providing leverage to those constituents, 15,000 companies. I actually think what White Oak is doing is traditional. And what sponsor lenders are doing is non-traditional. That's really, the asparagus on the plate. And what banks do, which is, probably 90% plus of the total balance sheet of all loans in the marketplace, they are traditional lenders. So there is a little bit of a challenge because there's a disconnect, not only of the return expectations, but also what the products are. So when you go to a bank's balance sheet, 50% of an average bank's balance sheet is in real estate credit, mortgages to commercial buildings, to residential buildings, like folks like you and I will get a mortgage, and also structured solutions, CMBS and RMBS. Now you go into the corporate side, which is called commercial industrial lending side of a bank's balance sheet. The product lines are typically asset-based lending, so receivables. You've got asset-backed loans like equipment, leasing, and financing. And you got bank loans, which is nothing more than a term loan. So that really is the total pie of a balance sheet of a bank, and that is traditional lending. So that's really what we do in providing leverage to sponsored companies. It's probably less than 1 to 3% of a bank's balance sheet. It's very small. So there's a disconnect about, I guess there's an educational need of what is private credit in a traditional sense. And on the return expectation, it's been a little bit frustrating. In today's marketplace, during the pandemic, and even where we are in transitioning out of the pandemic, investors have really high yield expectations. I've heard very smart investors tell me, look, Andre, if you're not showing up at the table with 10% plus returns, don't even bother knocking on my door, because if we're going to lock up our capital for a period of time, we need 10% returns. And of course, when junk bonds are trading at 4%, you've got to think that to get 10%, you need really equity returns. And so there is a little bit of a disconnect about return expectations and risk. So return expectations are easier to qualify and quantify, but the risk-taking part is where it becomes more difficult to explain. How much risk do you want a manager to take in order to get 10% returns? That's the real question. And some people are okay with leverage. They'll say, okay, look, give me 6-7% and lever that 1-to-1, and I'm happy. So there's a lot of flavors of the ice cream. I do think that private debt allocations have been coming from more of the alternative side of the balance sheet of pension funds versus fixed income. So that's I think what I see happening in the future as private credit becomes more mature and more sophisticated. I see allocations coming from the fixed income world, which is starving for yield, and not from the alternative credit side. So I do see that transition happening in the next 5 to 10 years.
Is the market still staying quite active right now? Is it, you're anticipating 2021? How do you expect 2021 to pan out in this market at this point?
If I had a crystal ball, I'd be investing in crypto and Bitcoins. But look, I think in 2021, the signals that I see is that there was a ton of capital raised in special sits, distressed, and opportunistic credit. Where is the distressed? I don't see a lot of it. If there's a distressed situation, that company's probably already in a SPAC by now. So we're not seeing that play out. There was a lot of allocations, made to those types of strategies. So I don't see a lot of deployment today. I do think that even though there's some whispers of inflation in the debt marketplace in the last week or two, I don't see a lot of inflation coming to the market unless the government's going to pump another $3 trillion into the system. We're steady Eddie, patient. We are happy providing liquidity to good businesses that bring a valuable service or product to the marketplace that should get bank financing, and for whatever reason, the bank's not there, and that fruit drops on the floor, and we look at it, and we could be a financier of that fruit. So that's really our position in the market. So we have about 120 plus 130 originators in the market. So we see a lot of deals and opportunities, and we feel banks are good partners for us. We are alongside banks on many deals where we don't have competing businesses. We're just simply there to support companies where their balance sheets cannot support. And their balance sheets are more liability driven. Our balance sheets are more asset driven. So we have a lot more flexibility in what we can do.
It's a great answer, and I appreciate that because it gives me the insights on how it plays with the banks as well. I'll shift a little bit just to get into how the COVID-19 pandemic maybe impacted the market as you saw it last year, and we're in the first quarter of this year and what's happening now. Did that impact how institutional investors were approaching the investments at this point, or was everything status quo with the COVID-19 pandemic?
Look, I right now it's a difficult answer because part of me wants to say it's mostly status quo. Unless you were in very challenged sectors, if you were a lender or equity owner of a gym membership company, or in the consumer discretionary world, etc., retail world, of course there's been a lot of pain. And I read one headline. I don't really believe every headline I read, but one headline read that banks are going to write off about $1 trillion in loans in their portfolios. When I say banks, that's probably I don't know if that's a U.S. number or global number, but 1 trillion write down is a big number. But you also have 4 or 5 trillion being pumped into the system. So when some people need that money because they got to buy groceries and got to pay rents and have shelter and pay their sewer bill. Others are putting that money and saying, okay, instead of my earnings being robust, my earnings are down, but I can pay my overhead, offset my overhead by getting a PPP loan or other government programs. But now I got cash, and what do I do with that cash? I have really 3 options. Put it into the bank, so you're lending money to the bank to make loans, or you are putting money into the equity capital markets or debt capital markets. So we've seen a robust debt and equity capital markets for a long time now, and that's predicated because money's been pumped into the system. It's got to go somewhere. Money doesn't go away; it goes somewhere. And so, is it artificial? Well, I don't know why you would think it's artificial. It's money is real, supposedly, but you can't do this forever because our debt just the balloons by $5 trillion. So there's more question marks about the future than answers, but we're seeing companies are adapting. It's amazing how humans and companies can adapt in dry spells and wet spells. You adapt and survive, and some have weathered away. Some weathered away for good, and some weathered away for a short period of time. But we're very pro-business. We're supporting SMEs. We're trying to save as many companies as we can. We are, some people refer to us as a white knight. If you talk to some of our borrowers, they're very pleased for us to come in quickly and underwrite the credit and trying to make them both survive and thrive in a difficult environment. And so that onus is on us. It's our financial responsibility to help companies, especially in difficult times.
Well, Andre, thank you for the answer, because you really covered quite a bit in this, and I do appreciate your time today. Is there anything else that you'd like to cover in this interview before we part ways?
The only thing I'd like to say, it's again, as investment professionals who are a lot of your audience, I would say, we do have a responsibility to step up and help businesses today, not to take their knees off and make a quick buck. So doing the right thing at a difficult time is, it's the right thing to do today.
Great. Thank you, Andre. Thanks for your time today. We appreciate your insights, and I hope you and the team stay healthy, and we'll look forward to talking to you again some point in the future. Thanks for your time today.
My pleasure. Thank you.